Hello, good morning, and welcome to the fifth video, the fifth lesson, and the fifth teaching of the TradeSmart series. In this video, I'll be teaching or highlighting about correlated markets and SMT divergences. So the first basic that we should know is when we're trading in the market, we are usually trading some sort of currency or commodity or instruments in general. For example, in this case up here we have XAG USD. This is basically silver with the United States dollars. So in this case we are supporting the currency on the left, which is XAG, which in this case is not even a currency, it's a commodity. So we are saying that if we are buying now, right, if we click on the buy button, we're buying silver, and we are betting that US dollar is going to lose strength in opposition in order for silver to move higher. So we're saying that silver is going to gain strength and US dollar is going to lose strength or become weaker. Well, at least that's the most ideal scenario. So I just wanted to point out a few correlated markets. I will highlight some of them in this video, but I will also link a video in the description and somewhere up here where I teach SMT divergences for those that already know about correlated markets. If you don't know anything about correlated markets, or if you just want to hear what I'm going to teach or show in this video, then you can stick around. The first thing we have to know is if we're trading silver, right, the correlated market would be gold. So in other words, if we are saying that silver is likely to gain strength, we are also saying that gold is likely to gain strength in the same manner. And we can see right here, we do have this sort of formation going down slowly, creating a swing low, creating another swing low, and then sweeping that swing low right now before 2 a.m. And we can see on gold we have something similar. Let's just delete these lines quickly, and yeah, we can see that we have somewhat of a similar situation, right, where price is going down slowly and creating swing lows that we swept. But of course, in this example, we can also see that silver is gold is a lot more weaker because we displaced lower even in an even more dramatic fashion, as opposed to silver, which was doing it gradually. So this is the first thing that I wanted to show, that every market that's correlated should ideally be moving in the same direction, or in the same fashion, or in the same momentum, or with the same speed. But what happens when they are not? What happens when one, for example, respects a BC and the other one doesn't respect the same BC that's formed at the same time? Or what happens when one sweeps a low and does not close below that low? This is a reference for the previous video, by the way. If you haven't watched that one, also just check the video, the link in the description, and if it's possible, I'm going to add it in this video as well. But we see, for example, one of them might sweep a low and the other one doesn't sweep the same low. Then that's what's called an SMT divergence. So let me just highlight this here quickly as we go up a time frame. So that's what we consider to be an SMT divergence. When one does one thing while the other doesn't do the same thing, we can consider that to be a possible crack in correlation and a way for the market makers to tell us that they are probably about to reverse price. They're probably about to take price to the opposite direction now. Let's move to the daily time frame of XAU USD, which is just gold as a commodity, and see what it looks like. And we can see on the daily time frame, this swing high created up here is the all-time high. So let's highlight that. I'm just going to highlight it as buy side liquidity. And then one thing you can notice is that right now we've currently disrespected this buy side imbalance because we have closed below it, right? But at the same time, we are now trading in an even discounted buy side imbalance right here, we have this fair value gap that's in more of a discounted price over here. Why do I say that this is more of a discounted price? Well, that's because if you measure from the range low, in other words, the latest, what's the last swing low that you see in price, in using this piece of price action, we can see that that's the last swing low right there. So if you measure from that swing low to the last swing high that we created, which is the all-time high, you would notice that the 50% is over there, which means anything below it is discount and anything above it is premium, right? Anything above it is expensive than here. That's just common sense when you look at the price here. For example, right here, where price is right now, gold costs $2,364 an ounce, while up there it costed $2,442 an ounce. So obviously it's much cheaper here than it was up there in premium, which is anything above the 50% of this range. So right now we have traded into a discounted PDRA, or a discounted BC, or a discounted fair value gap, and we could possibly see this fair value gap be respected for higher prices to the buy side liquidity. I know that was just a lot that I shoved in one piece of information, as in one short segment of this video, especially if you are new. But the thing that I wanted to show is an SMT divergence, so let me try and jump straight to that now. And we pull up silver from the daily time frame. So let's look at silver in comparison. First thing we notice already is that silver looks so much more stronger, because this swing high that was created here is the same as that swing high, and you can see gold barely swept it while silver properly swept it and even closed above it multiple times. So I'm saying this because if we pay attention to this fair value gap right here, looking down there, we can see the date, right? This fair value gap was created on the 15th of May 2024. Let's highlight the same fair value gap on silver, which is right there, the 15th of May 2024. So in comparison, right now we can see that silver is so much more stronger because silver is still within this fair value gap up here, right? So this is a possible sign of an SMT divergence, where one takes a swing low while the other one doesn't, or in this case, one taps into a fair value gap while the other one doesn't. So if we compare the low from here to there, we can call that an SMT divergence, because let's bring it out a bit more so it can look cleaner. If we do that and then we do this, it's almost as if we're just looking at the low of this candle from the 16th of May. And we notice that on one asset, the low was swept, the low of that day was swept. On the other asset, it wasn't swept. So that's gold versus silver. So this could be a possible crack in correlation, and this could be indicative of higher prices from here. So nothing, of course, is set to stone, as I've been repeating multiple times in my videos, but this could be a signal for us to go long or buy gold or buy silver. Of course, you'd rather buy the stronger asset in this case, which is silver, because it was unable to get to this discounted PDRA, or this discounted fair value gap. So that's correlation. But I know now some of you might ask, okay, well, that's the correlation for silver, but what I don't trade silver, I don't trade gold. What about GBP USD? What about euro dollar? Well, that's fine, because if you are looking at anything dollar related, you should be looking at the DXY. Of course, some of them can be inversed while the other ones are not. For example, if you're looking at GBP USD, personally, I would be looking at GBP USD compared to euro dollar to look for my cracks in correlation. And already we can see one over here where euro has traded into this fair value gap. Euro has also swept the low of Friday, May, which is over there, while GBP has not swept the low of Friday over there, Friday the 17th of May. So this could be a crack in correlation, but it's something to pay attention to. Even at the highs, we have GBP sweeping these highs from the 21st of May, while Euro was not able to. So this could also be an indication for lower prices. The fact that we were unable to sweep the previous daily high, while GBP was able to do so. So these are just simple, smaller signs of possible reversals in price, and I will go in depth more on them as we round up the month, when we finish with the series on SMT divergences and how to pay attention to them and how it actually incorporates with my trading model and how I make my ends meet. So obviously I just mentioned GBP and Euro. Euro is just closer related to GBP, so anything GBP related, so it should be compared to Euro for SMT. For example, if I'm looking at GBP AUD, what would I be comparing it to? Well, I hope you said Euro AUD. If I was looking at GBP NZD, I'm hoping that you guys would be saying Euro NZD as the sister or the comparison, the compared asset class. So it's just as simple as Euro pairs up with the pound and New Zealand dollar pairs up with the Australian dollar. And then of course, as I just mentioned, now anything with the dollar should be paired up with DXY no matter what. So if I was looking at GBP USD again, let's go back to GBP USD. Notice how the highs here was swept. The high of the 21st of May was swept yesterday on the dollar. Okay, let's put them side by side. On dollar, which is DXY, we would expect the opposite to be the case. We should expect the low of the 21st of May to be swept, and when we look there, we see the 21st of May is right there, but notice the low was not swept. So we do have an SMT at the lows over there, just as we do at the highs, because these are oppositely correlated. I know that's not a real word, but in this case, dollar failed to sweep the lows, while while pound successfully swept the highs. So that's an SMT divergence there. And this is true for Euro dollar as well. And then of course, if I'm looking at anything that starts with the US dollar in the beginning, like here we have USD ZAR, USD JPY, USD Swiss, USD CAD, we would be looking at them as positively correlated markets, because the dollar is the first one in the pair, right? The first currency in the pair, or the one on the left, which is USD right there. So if we're expecting dollar to push up more, then we should be expecting USD CAD to push up more, right? So it's just as simple as that. It's just as simple as one following exactly what the dollar is following. So if you're looking for a market that's correlated with the dollar, or correlated with USD CAD, for example, it should be the dollar index directly. And notice we do have an SMT there. On Friday the 17th, we swept the lows. We can clearly see the liquidity sweep happen down there. And let's check Friday the 17th, which is right there. We failed to sweep the lows. It almost looks like equal lows, but trust me, it's not. When you look closely, you'll be able to see that we did not sweep those lows. And at the end of the day, the thing that matters is whether we swept it or not. And here we can see that we didn't sweep the lows. So that's a small crack in correlation, and that could have been your signal or indication to take price higher, to take this as a liquidity sweep and just buy the next candle drop down or something like that. Of course, we will go deeper into this and make even more sense, and how I personally use it on my day-to-day trading. Of course, doesn't mean I trade every single day, but how I make my ends meet. So I would say study the cracks in correlation. We have US oil with UK oil. We have BTC with Ethereum, which is ETH. We have all the interest rates differentials over there. And then of course we have the indices over there. The YM, NQ and ES all working together, which is the Dow, the Nasdaq and E-mini S&P 500. And then yeah, we have every other pair correlated with each other. If you have any questions, if you have any questions on, let's say you want to know what pair is correlated with the other, just ask me. You can ask me directly on the Telegram group that I link in the description, or you can ask in the comment section of this video down below. But if there's nothing else, and if it makes sense, if the cracking correlation makes sense, if my basic teaching, very basic teaching of price having to follow each other makes sense, then that's good. We're on the right track, we're on the same page. But if it doesn't, then please do let me know, and I'll hopefully be able to make it make more sense to you. For now, stay safe, good luck, and good trading.